The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
A bit of fatigue sets in for the record stock rally. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Katie Greifeld. We're kicking you off to the closing bell here in the U.S. Like Romaine said, 7 straight days of wins on the S&P 500. Snapping today, the S&P 500 down about 0.4%. A lot of that comes back to big tech, which we'll get to. But I wanted to highlight what a risk-off day this is. You have stocks down, you have yields down as well. Folks going into bonds right now, also going into gold. We're on $4,000 watch when it comes to gold. And then I wanted to highlight the VIX as well, rising pretty sharply here. We're now trading above 17. So all in all, risk appetite really souring today.
Absolutely, and that brings us back to big tech. Remember, heading into this month, it was really all the thematic baskets out there that had been leading the stock market higher were directly or indirectly linked to AI. That meant that any hiccup in the growth narrative was bound to reverberate. And today, we got it. That report from the media newsletter, The Information, striking a nerve, claims that the data center company Oracle losing money on its NVIDIA-based server rentals with gross profit margins averaging 16% for a tech services business. 16%, that's a tighter margin than for most major retailers out there, including Kroger, TJX, and Home Depot. Now, I do want to be clear here. Today is not the pinprick moment that bears have been watching for, but it is certainly a test of bullish conviction to an AI trade that so far has been able to ignore a lot of the hard questions about cash burn and about the increasing pivot to debt markets to support this trillion-dollar corporate spend on AI infrastructure. And therein lies the conundrum. Top-line revenue growth for the AI cohorts is second to none. But margins and net income, they aren't swelling as fast, if at all. The Oracle news dragging down other players in the server rental ecosystem like CoreWeave as well as NeoCloud darling Nebius. The news coming just hours after Chris Montague's team of strategists over at Citi actually flagged profit-taking risk for AI stocks after 30 record highs for the NASDAQ 100 this year.
And on that note, Romaine, I wanted to highlight the volatility that we're seeing in those big tech stocks. We were talking about the VIX. That's on this chart behind me in blue. And then you have the NASDAQ 100's version of the VIX in white. You can see that typically you do have a bit of a volatility premium there, but it's starting to grow more pronounced. Right now, the big tech volatility is about 4 vol points higher than that of the S&P 500. We haven't been at that sort of disconnect since August. And just you think about the news flow of this week, the multi-$100 billion swings that we're seeing in a lot of these big tech names. This could be the chart to watch as perhaps you start to see volatility measures on the NASDAQ 100 march even higher, Romaine.
All right, as we kick you off to the close here on this Tuesday afternoon, let's bring Andrew Slimmon into the conversation. He's Senior Portfolio Manager with Morgan Stanley Investment Management. And Andrew, I do want to start off with this bull run. We're 3 years into it now. And of course, the last couple of years have been largely fueled by the AI trade. Is that still intact?
Well, I do. I think it is, Romaine, but one of the things that worries me is, and you've already touched on this, is the nature of the rally has gotten a little riskier of late, which is the market seems to be rewarding the more speculative parts of the AI trade more today over the last month than it had previously. And, you know, my number one worry for this bull market in general is ultimately bull markets die on euphoria. And euphoria is when the speculative stocks capture all the interest and they soar. And that worries me because that's what we've started to see over really since Jackson Hole. And a sell-off in these types of names today, I think, is a very healthy sign.
When we talk about, I guess, the potential for a reset in the rally, the idea that this is more of a slight pullback rather than a huge about face, Andrew, what gives you the confidence that this is indeed just a speed bump?
Well, first of all, if you look at those types of names, the very speculative names, they've done well. But they're not at the valuations that we got to in 2021 or in 2020, nor are they crowded. I think they've captured a lot of retail interest, but less so institutional. Tells me there is more to go. But ultimately, that's going to be the way that, in my opinion, the bull market ends, in too much zeal for these types of stocks, and then something is going to disappoint and bring it down. But that could be quite a ways away. I think it's still premature.
So we're talking about the bull market, which really means that we're talking about big tech. And Andrew, it's hard to tear your eyes away from what's happening in that sector. But I'm taking a look at your notes right now, and you favor financials in addition to technology. And I wonder, what the bull case is there and what the investor appetite is as well, since it seems like so much mind share is being taken up by tech right now.
100%. However, starting in a week, we're going to start to get big bank earnings. And I think they're going to remind us, they're going to wave their hand, Katie, and say, hey, wait, don't forget about us. We're doing pretty darn well. I think that will be an opportunity for the market to pivot and say, there's more going on out there in good fundamentals than just the AI trade. Seems like right now that's all we're talking about. But I think the setup going into earnings for financials is very good, which is people have largely forgotten about them of late, and I think that is an area that is also doing well. So as much as I get the argument that the AI trade is captured the spotlight and the returns of stocks of late, fundamentally I do believe there's other areas to invest that offer good diversification, so that you're not just chasing one AI trade.
Well, I want to talk a little bit more about the financials, because when you say financials, a lot of folks think of 5 big banks. And then you take a look at sort of the sector performance breakdown there. It's names that you might not expect. It's Robinhood, it's Coinbase up there as well. You also have some asset managers doing well as well. And it's a good reminder that banks are just a small slice of the financials. So when you say that you like financials here, are you talking about the sector as a whole, or are you talking specifically about formal banks here?
Well, I mean, what's intriguing about the stocks you listed is some of them are ultimately yet another kind of speculative stock trade. I mean, what has worked of late? Quantum computing, nuclear, crypto. Some of those financials are capturing that. So if those themes sell off, some of those financials will. I don't think the big banks will. It would cause a rotation. The correlation is not there. But I do think you have to be careful in terms of which ones you're buying, because the ones that have worked recently are really just yet another play on these speculative stocks. I like the big banks. I like the asset managers, because I think as money comes out of these bloated money markets, rates are dropping. People are not going to be as content in leaving their money in money markets. That will go into other vehicles that inherently have higher returns for asset managers. So I think the asset managers, the wealth management, and the banks are a diversifier away from that AI play.
All right, Andrew, got to leave it there. Andrew Slimmon, Senior Portfolio Manager at Morgan Stanley Investment Management, kicking us off to the close here on this Tuesday afternoon. When we come back, we're going to talk about investing specifically through the lens of the sports world. It was 2 years ago when Marc Lasry and Avenue Capital launched that mega sports fund. It closed it just last week. A conversation with Marc when we come back after the break. This is The Close on Bloomberg.
Well, last season's Stanley Cup champs, the Florida Panthers, facing off against the Chicago Blackhawks tonight as the NHL kicks off its 2025 season. Our next guest is no stranger to sports investing, as a former owner of the Milwaukee Bucks and the newest manager of a more than $1 billion sports investment fund that closed last week. Joining us live now from Citadel's Future of Global Markets Conference in downtown Manhattan, Avenue Capital co-founder and CEO Marc Lasry, alongside Bloomberg Open Interest co-host Danny Berger. Danny, take it away.
Katie, thank you so much. That's right. I am here with Avenue Capital's Marc Lasry. Marc, thank you so much for joining.
My pleasure.
First of all, congratulations. You've made the announcement. You closed your $1 billion sports investing fund. I think there's a lot of excitement around it. So now with this close in hand, what's the strategy of the fund? What are you using at the moment to identify opportunities?
Well, we have a pretty large team, but really what we're doing is just investing in sports. And the question is, do you want to do emerging leagues? Do you want to do women's sports? Do you want to do the big four? And we're trying to do a mixture of all of them. Things that we think over the next, sort of 5 years are going to double or triple.
You're far from alone, I should say. It feels like there's been just a spat of announcements recently. Apollo announced that they had a sports platform. Ares has been talking to investors about their sports fund. You already have the likes of CVC, Arctos already existing in sports. It's a small asset class comparative to the rest of private equity. Are we reaching a point of potential saturation?
Not even close. First of all, I've never heard of those groups, just so you know.
I'm sure our viewers have never heard of them either, Marc. Never heard of them.
All right. You've got to look at this. Everybody you mentioned, they're actually great firms, but the amount of capital that's in is actually very small relative to the amount of supply. So the market is $1 trillion market. It's this massive market, and you're talking about maybe $10 to $15 billion of capital that's been raised or that's looking to invest. So the opportunity set is huge. I mean, that's really what it is, and that's why you're finding more and more firms like ours and more private equity firms that want to come in, because you're literally in the first inning. And I think this is something that's going to last for a long time.
So what do you make of those who say the big four, especially now that you have PE in that market too, it's overvalued, it's frothy, it's bubbly? Is there any validity to those comments?
I think people have been saying that for the last 20 years. Like when I bought the Bucks, I paid $550 million. At the time, this was 12 years ago. At the time, believe it or not, we had paid the most for any team in the NBA. All right, 12 years later, the Lakers sell for $10 billion. So the Celtics sold for $6 billion. What you're seeing is that there's just the demand for live sports is the one thing that keeps on growing. So nobody records a basketball game or a football. Nobody records the Super Bowl and says, hey, let me watch the last 10 Super Bowls, right? So it's unique. It's different. That's why the value keeps going up, and I think that's the reason why it's going to keep going up.
Yeah, well, to your point, you've participated in the Big Four. You are currently, I know you also own the Orioles alongside my boss, Mike Bloomberg. But you're also very much so focused on emerging sports and women's sports. Just how much does the value proposition differ between the two?
Oh, I think it's where you can make fortunes of money. So if you sort of think about women's soccer, NWSL, 5-6 years ago, you could have bought a women's soccer team for around $1 to $2 million. Today, those teams, I think, are around $150 million. We've invested in a group called Mercury 13 in Europe, where we're investing in women's soccer teams. We've bought a few, and we're under contract to buy a few more. We're buying those teams around £5 million or 5 million euros, however you want to look at it. We think in the next 5-10 years, those teams are going to be worth anywhere between 25 million to 100 million. So where you can make sort of 5, 10, 20 times your money.
So for those who have been, and we won't name them, for those that are just concentrating on the Big Four leagues, do you think that that's a losing strategy?
No, not at all. I think they're going to do very well. I think what you've seen in the Big Four is that the returns have been somewhere around sort of 10 to 15%. I think that's a great return. I mean, it's not correlated. You're going to do exceptionally well. I don't think you're going to make 5 times your money, but I think what it is a safe return. And we're looking at investing in those. I think it's very safe. You're going to do well, but you're not going to have the huge growth that you would in something else.
Well, speaking of huge growth opportunities and changing sports, what about college sports? Is there any opportunity to get involved there?
I think that is one of the biggest opportunities out there. It really is. And, we've been close to getting a couple deals done. Just hasn't gotten done. But I think over the course of the next 2 or 3 years, you're going to start seeing that there's going to be a number of private equity firms, hopefully we'll be the first, but that people are going to be doing this because of the NIL issue, because of all these other issues, schools need capital, and they're going to need that money. And so the question is, did they take that capital from us, or did they take it from their chemistry department?
How close have you gotten to reaching some of these deals? Might we expect any announcements from you anytime soon?
Oh, I would.
If you want to make an announcement here, we're also very happy for you too.
I could. I'd love to make an announcement, but I think I got to wait till we actually get it done. I think we are probably 3 to 6 months away, but the issue is always subject to board approval or the trustees. And I find that people don't like being first. They're always first to be second. They never want to be the first.
Marc, I'd be remiss if I let you go without asking about this wider moment we're in private equity. There's been this argument that the industry was overinvested in 2021, 2022. Now they're having a hard time finding exits, hard time with distributions. Fundraising has been difficult too. Do you think that this is an existential moment for the industry as a whole? No,
not at all. Look, I think what people forget is you're supposed to look at this over a 5 or 10 year horizon. If you're going to look at it over a yearly horizon, it's never going to make sense, right? So yes, is it harder to raise capital? Yes. So who's getting that capital? People who are making money, right? I think that's the big difference. Is it hard to sell? Yes, it is. Why? Because as a seller, you want the highest price, and as a buyer, you want the lowest price. And today, both sides feel they have the leverage. Sooner or later, somebody breaks. And the reason you've got this nervousness around the market and in the industry today is because nobody knows what's happening with the economy. Is the Fed lowering rates? Is the Fed going to stay where it is? Are we going into a recession? What's happening? So when you're nervous about what's going on, what do? You wait. You wait and see, and that's what's happening right now in our industry. All right, Marc, we're going to have to leave it there. It's been so wonderful to talk with you. I think we could probably do this all day. Looking forward to the 3 to 6 months when you have an announcement for us. So am I. Thank you. Thank you so much, Marc and Romaine. That's, of course, Marc Lasry of Avenue.
All right, Danny, thanks there. Marc Lasry, of course, out there over with Danny Berger down there in Lower Manhattan. When we come back after the break, we're going to talk about home builders. A big slide that we're seeing in some of the names today, pretty much on the back of a big downgrade by EverCore ISI. The analyst behind that call is up next. This is Bloomberg. Let's get right to our top calls. Big movers on the back of analyst recommendations. And we start off with Synchrony Financial, a downgrade over at J.P. Morgan for the credit card loan company, down to neutral amid higher delinquency rates and a divergence in high income versus low income consumer health. Next up, Dollar Tree. Jefferies cutting to underperform, reducing the $100 price target to a street low $70. The analyst says a simple discount retail business model has now turned a lot more complex. And finally, D.R. Horton, EverCore marking down their rating to in line from outperform on D.R. Horton. It's one of 6 cuts by EverCore in the home building sector. With the analyst writing, we think that the softer than expected response to the recent drop in mortgage rates actually reflects the fact that affordability wasn't really the main culprit behind this year's sluggish demand. Pleased to say that the analyst behind that call joins us right now, Stephen Kim, Senior Managing Director and Head of the Housing Research Team at EverCore ISI. This is about demand. This is about supply. What, Stephen?
Actually, it's also about government involvement in the housing space, seeking to address affordability. We think that that could have unintended consequences, and in particular, we think that the direction that the administration is focused on right now is towards supply-side solutions to a housing affordability crisis, and they are that this is likely to be very much at odds with the factors that would drive the home building stocks higher over the near term. And so that's a very important part of our downgrade as well.
Give me a sense here of what is going on right now with rates. You talk about in your note how the administration would be better off focusing on that mortgage rate spread rather than the actual home prices themselves. Explain.
I think the fundamental disconnect is that we believe that the primary issue that is facing the market right now is that there is a lack of demand. There's inadequate demand, not inadequate supply. In fact, I think that we have seen all year that the builders actually have unwanted levels of unsold units under construction and completed units. So we don't actually have a shortage of housing so much as we have some slack demand. And I think that if the effort here is to increase production, that will actually put a downward pressure on price and therefore margins. We think that some in Washington believe that this would actually be a good thing, that the builders perhaps are making profits that are a bit high, that they're generating strong cash flow. Buying back stock could suggest they have excess cash that maybe could be applied to reducing home prices. I actually think that that's a misguided interpretation. I think the builders have been working very hard in a very difficult environment to be as efficient as they possibly can. But I think that we have to acknowledge that in the near term, if the focus is to depress cash flow, margins, share repurchases, that this is going to go diametrically opposed to what investors in this particular space are most looking for over the next few months.
And Stephen, it's striking to me that when I take a look at your coverage universe, you're a hold on 14 names. You have no sells, you have no buys. I have to imagine that you're in a pretty rare company there. So, I mean, when you think about some of the different home builders that you do cover, I understand, again, you have a hold rating on all of them, but are there any names in particular who are best positioned to navigate some of these cross currents that you just cited?
You know, it's interesting. I actually believe that the builders as a group, and particularly the large cap builders, we're talking about D.R. Horton and Pulte and Toll Brothers and Lennar, are extremely well positioned to perhaps see a very significant positive revaluation to higher multiples over the next couple of years. And we've been waiting for that to be catalyzed by things like stabilizing margins, improving cash flow, increased share repurchases, and the like. Which is why, you know, this recent focus by some of the government entities to maybe, you know, seeing that as maybe a bad thing is something that really weighs on our thinking on the space. But we actually like a lot of what's been going on in the housing space, and we think the builders have done a really very good job becoming much better companies over the last decades, and that has not yet been reflected in the valuation. So there's a little bit of tension here in our valuation or in our ratings because we actually like the group long term, but we think the next 4 to 6 months could be extremely difficult times to navigate. And in particular, we think the most recent changes are going to be perceived negatively by investors, understandably, frankly.
Right. All right, Stephen, really great to get some time with you. That is Stephen Kim. He is Senior Managing Director and Head of the Housing Research Team over at EverCore ISI. Now, coming up, ready, set, IPO? Maybe not. With no deal to end the shutdown in sight, industry lawyers are advising their clients to sit tight. We'll discuss with Ted Smith up next.
There's a lot of merger talk. There's a lot of firepower. There's a lot of tech. You know, we had a bunch of IPOs in the U.S., and I know there've only been a handful here. The tech world is still doing quite well. You know, the 800 companies here. I think it was 400 last year. You know, we now have 500 bankers coming the innovation economy globally around the world, including we've added like 50 alone here. So, look, I'm a long-term optimist.
JP Morgan Chase CEO Jamie Dimon speaking a little bit earlier out at the Techstars conference overseas there with our very own Tom McKenzie. It's 3:30 p.m. here in New York, and Katie Greifeld, he talked a lot about M&A activity, but we also heard from some of his deputies there that were specifically talking about the IPO pipeline and whether it would actually open up.
Yeah, it's still strong, and specifically some of his deputies saying that the private for longer mantra, it's starting to fade a little bit. And we've been hearing this for a while, that the pipeline is strong. We've had data to actually back it up. It seems like in the summer that actually came to the forefront, and you saw companies actually going public once again.
Yeah, and you see this here, but now there's some concern that we are in a government shutdown. So basically that means that if you got an application with the SEC or you're about to submit one, it's not really going anywhere. You got basically a skeleton crew operating. That means nothing's getting done, right?
Yeah, we walked through some of the good news, so let's dig in on the bad news a little bit more. That shutdown could slow this IPO revival, putting billions of dollars worth of deals on pause as the SEC remains mostly closed. Let's discuss with Ted Smith. He is president and co-founder at Union Square Advisors. Ted, great to have you with us. So the SEC pretty much in limbo right now. You've seen some planned IPOs get put on the sidelines. Beyond just the logistical nature here, companies not necessarily being able to go public, what does this mean for sentiment at this moment for some of those IPO candidates who have been waiting for their turn for a while here?
Well, Katie, first of all, thanks to you and Romaine for having me back on, particularly for the negative segment. But I think it really doesn't affect the long-term sentiment of the market. I think it's an annoyance. I think as companies are gearing up to pursue their IPO path, only to be sort of halted for the moment by the government shutdown, that's not something that anybody loves. But I think the reality of it is we've seen such strength in the IPO market this year when compared to last year and certainly the year before that. We've got twice as many tech IPOs this year in 9 months versus what we had for all of last year, 4 times the amount of capital raised in the tech sector this year so far versus last year. The markets are clearly open from an investor perspective. As long as the government doesn't delay or keep the shutdown for a very long time, I think that as soon as things open back up, people are going to be ready to go again. The last time we had a shutdown like this, late 18, early 2019, about 35 days. It certainly put a halt to the IPO process and companies looking to come out at that time. But as soon as the government shutdown was put to bed, there was a flurry of activity. And frankly, I'd expect we'd see that again this time around.
All right, so waiting for flurries here. But Ted, you make a good point that we've seen a lot of tech IPOs. That seems to be the bulk of it. We've seen a lot of crypto IPOs as well. So the fact that it seems like the new entrants into this market have been pretty concentrated in those 2 buckets, does that say anything to you at this point?
I think it says that the public market investors generally who are continuing to seek growth. Growth is still the watchword for investors, certainly in tech and crypto, but more generally, they see these areas, they see things that are infused with AI at this point in time as being interesting, the way to achieve their long-term return objectives. And so the fact that you've seen a lot of those companies come public is really just the underwriters and the companies themselves giving those public investors what they say they want, growth and exciting large market opportunities.
I am curious about the path for some of these private companies. And when we talk about sort of this idea of how mature some of these companies are relative to past cycles, I am curious at whether that actually ends up being a little bit more of an asset when they do finally actually hit the IPO market relative to in the past.
I think it certainly does, Romaine. That's a really good point. The reality of it is, and at the intro you're talking about private for longer, the more capital that these companies take from increasingly later stage sophisticated investors, the more demands are placed on the companies to begin to think and act like public companies, managing themselves to quarterly reporting cycles, expectations for profitability and increasing profitability over time, more repeatable and sustainable revenue growth. All those things that are very difficult to achieve for an early to mid-stage private company can become more attainable for later stage private companies. And if they're held to that standard, then to your point, I think once they become public, it's a little less jarring than it can be for an earlier stage company that's all of a sudden flooded into the public market.
There's also been a lot of talk when people sort of raise this question as to why some of these companies would even bother with the public market, at least particularly for those that are generating pretty decent cash and even maybe profitability. One argument that I've seen posited is this idea of growth through acquisition, and the idea that it's going to be a little bit easier to do that if you have, public stock as your currency, more or less.
We certainly continue to see stock being used in some M&A deals within the tech sector. I don't think that goes away, although the bulk of the strategic transactions that have happened in tech over the recent past have been cash-driven as opposed to stock-driven. So it's not exclusively about that. Certainly, greater liquidity for existing investors and employees is always a big factor when you think about the potential for an IPO and having a liquid currency. So I think if these companies are able to get public, as we're suggesting here now, having that currency for M&A is certainly a positive, but I don't think it's required, because with all of the additional cash and the investors desiring to put more cash to work in these large-scale private companies, there is still an opportunity to do M&A. They just have to use the cash as funded by the investors that are coming in.
And Ted, when it comes to M&A, specifically tech M&A, you make a really interesting point in the notes that you sent over to our producers that you take a look at volume and deal count for larger transactions. It's up year to date by both metrics, but then you take a look for those smaller transactions, less than $1 billion. That's actually down year to date or year over year. And I wonder what that says, that it's more the bigger ticket deals that seem to have more interest versus maybe some of those smaller combinations that you might think would be easier to get done.
Yeah, the data are really interesting around that. And as we try to parse through that, I think there are a couple things to learn. One is that in the current regulatory environment, leaving aside the government shutdown component for a moment, there's a belief that some of those larger deals are easier to get done than they might have been under the previous administration. And so some of the deals that may have been pent up for a while that were larger are believed to be able to get done. Again, to my earlier point about AI, some of those transactions by their very nature are just large. They're north of that $1 billion line that you've mentioned, Katie. And so as those deals start to get done, they creep up and well into that larger deal scenario. I don't think it's fair to say that because there are fewer smaller deals in terms of number or dollar volume this year, that there aren't any or there's not meaningful M&A activity below the $1 billion line. We've seen a lot of that and continue to see a lot of that. And I think this year, by the time we get to the end of the year with a strong fourth quarter, we'll at least be on par with last year. But there's no doubt that those larger deals that have gotten done and are able to get through the regulatory process have dominated this year versus the smaller deals.
All right, Ted, always appreciate you taking time for us. Ted Smith there is the president and co-founder over at Union Square Advisors, helping us count you down to the closing bells as we take a look at the private markets, particularly in the tech sector, and turn to public markets in the health of the tech sector. Oracle shares sliding. This after a report by The Information questioning the profitability of its cloud AI data center business. This is The Close on Bloomberg. A bit of a pullback in shares of Oracle today. This after a report by The Information saying that the software maker's cloud computing profit margin is likely going to be lower than expected. Though the company generated $900 million in revenue from renting NVIDIA-powered servers, it apparently has only raked in about $125 million in gross profit. Joining us right now to talk a little bit more about our stock of the hour is Norah Mulinda. And I think this, Norah, rattled a lot of people, not necessarily because the numbers are awful, but the idea that for all of the talk about this AI trade, we've been so focused on top-line revenue growth, and we've kind of ignored the bottom-line numbers, profitability and margins. What do we know?
It was certainly a surprise to many, especially given the fact, as you mentioned, there's been so much optimism behind this. Just last month, the company said that they projected revenue to jump by 700% over the next 3 fiscal years, particularly in this segment. So, I mean, there's been a lot of anticipation going into this, not only about the broader AI story, but really about what Oracle can contribute here. And so you are seeing that reflected in the trade as we are seeing a bit of a breather here.
We'll wrap NVIDIA into this conversation. I thought this was an interesting detail in the Information's report that in some cases, Oracle losing considerable sums of money on their rentals of NVIDIA chips. You can see NVIDIA shares pretty much unchanged on the day.
Right. They're not seeing too much of a knock here, but certainly you are seeing this, really seeing a bit of a pullback here in regards to Oracle, and especially a spokesperson for Oracle, particularly, they don't publicly disclosed the AI cloud servers unit financials. So they didn't have a comment in particular on those figures. But I mean, if you think about the stock more broadly, it's had a pretty good year. Shares are up about 70% so far year to date. Yeah. So when you put this pullback into context, it's not that crazy.
It's not that crazy, but there are some fundamental issues. We should point out some of the other stocks in this space, like Nebius, CoreWeave, are also moving lower on this. The Information article brings up a good point, which is this idea of the gap between effectively what Oracle and these other firms are paying NVIDIA. We know these chips are basically premium price, based on what they can then rent out that to the end consumer. And I am curious about that gap. And I know we don't have the original reporting ourselves, but it raises the question that if that differential is still narrow and is not widening in favor of the Oracles and CoreWeaves of Nebius, how long do they stick
Then what do you do? Yeah. Right, and I think that that is really the question here that you're starting to see really ricocheting across Wall Street. I mean, if you think about all that we've really pumped into this idea of them being able to be major players in this race here, it starts to make you question, you know, how much are they really able to pull forward in this respect here, or are they needed in certain areas in that space, and how much further can they push along? What are they able to really pump out of this here?
All right, yeah, a lot of big questions, a lot of existential questions, too, when it comes to this area. That is Norah Mulinda reporting on Oracle right now. It's interesting. It feels like you have a cacophony of caution around what's going on when it comes.
I like that, cacophony.
Thank you. That actually
you have a way
just.
with words, yeah.
Thank you. I just thought of that, too. But anyway, it feels like there's a lot of caution being thrown around AI spending. There was a really interesting conversation that I believe was had at the Greenwich Economic Forum with Ares Management co-president Kip DeVere, basically saying that there is a risk that we're overbuilding when it comes to data centers right now.
And I saw there was some interesting data out by the folks over at J.P. Morgan. We're talking to something like $1.2 trillion in high-grade issuance, and a lot of that is basically directly tied to AI. And this has been kind of, I think, hidden under the surface, is everyone's assuming that a lot of this CapEx spend is being funneled with cash from the balance sheet. But we're actually starting to see a little bit more borrowing. Even Oracle said, obviously, went back to debt markets to fund its streams as well.
I think that's going to become a bigger conversation, whether or not this changes the profile of investing in those tech names if they're going to have to rely more on debt to fund these ambitions.
How much are you spending on your AI ambitions?
Practically zero, I would say, but I'm sure there's some.
Good. Well, the ROI on that is great, by the way.
Thank you. All right, coming up, we're about 15 minutes away from the close. We'll bring you there with Jerome Schneider. He is Managing Director and Head of Short-Term Portfolio Management over at Pimco. That's next. This is the close.
10 minutes until we get to the closing bells here on this Tuesday afternoon, coming off a record high after record high, Katie Greifeld, but a pause today, a rethink of the AI trade.
Yeah, unless something amazing happens in the next 10 minutes, we're going to snap that 7-day win streak on the S&P 500. As I said at the top of the show, it's a real risk-off day. You can see that across asset classes, a bid going into bonds, a slight one, but a bid nonetheless. You also have gold looking to hit $4,000 per ounce. That amazing run continues in the yellow metal. And then you take a look at the VIX, volatility rising on the equity market right now. The VIX trading with a 17 handle, Romaine.
A 17 handle as we see the price action start to pick up. As we move closer to the closing bells, Jerome Schneider joins us here in Studio 2, Managing Director and Head of Short-Term Portfolio Management and Funding over at Pimco. Jerome, there's been a lot of talk today about this report on Oracle, whether there's cracks in the AI trade. But I want to start more broadly here with just general sentiment right now in this market, which we've seen record highs in equities. At the same time, we're seeing record highs in a safe haven like gold. And at the same time, we're seeing still records in terms of cash and cash-like holdings in markets right now, at least as measured by money markets.
Yeah, I think there's two elements here that we have to focus on. The first one is animal spirits. Risk-taking is still relatively prevalent in terms of the marketplace. You can see it in the form of tight credit spreads in public markets as well as private markets. You can see it in the form of equity markets and equity risk premium. And that's pretty much where we stand right now, is that the markets are paving way to an optimistic view that things are going to be A-OK over the intermediate term. At the second half, we also have a situation now, especially with the government situation, where investors are seeking visibility. And that visibility factor is one where it's confounded by obviously lack of data in the near term, a jobs market which is coming a little bit off the boil, and we had some uncertainty there, inflationary expectations which are going to trend higher through the remainder of the year, and simply what is going to be the incremental facet which drives markets higher, equity markets higher, credit spreads tighter on a go-forward basis. And so this visibility question becomes really in focus, and unfortunately the market practitioners as well as the monetary policy actors, including the central bank in the United States, have to react to this without great visibility. And that's why cash has become a dominant theme over the past year.
Well, will cash remain a dominant theme? I mean, you go back just, what was it, only 2 years ago, you were getting 5.5% on a 6-month T-bill. Even last year, I think you were still getting above 4%. And as of right now, we're like at 3.8%. And it's been a trend line sloped downward.
Exactly. At Pimco, we expect another 2 rate cuts for the remainder of this year. And while the visibility of those rate cuts might be clouded as we get into 2026, the important thing to recognize is that the comfortability of cash, cash, that being able to sit in cash and earn that 5% yield is dissipating quickly. We need to be able to move out of cash that's going to be trending to that 3% or lower number in terms of that yield and income, and find ways to preserve that income. And simply looking at the broader set of fixed income, adding a little bit of interest rate exposure, even if it's modestly moving out to a one-year type of strategy, affords you ability to preserve that income, be above that 3% number, and at the same time optionality to have some liquidity. And so we think that there's obviously opportunities to be in well-diversified portfolios over the intermediate future, despite the lack of visibility from the Fed, as well as the outlook for the broader economy.
Something that I always think about when it comes to cash is that for a lot of people, it seems like it's turned into an alternative to put their money that's not in the bank, that's not in a traditional deposit account. And certainly you take a look at the 5-year chart of money market assets, it was really in the aftermath of SVB that you saw a big leg higher in cash. So if you take a look at, that 7.4 trillion from that lens, that for a lot of people that's acting as their bank, how do you think about that in terms of the stickiness?
Yeah, it's not just individuals, it's also corporations, central banks, official institutions, but it is a large amount of money. And we think at Pimco that number is somewhere between 8 to 10% of that money market fund assets that's actually risk seeking. And so put that in a number of $500 to $800 billion. The important thing is that as these yields go down, there are two effects. Number one, obviously your income generation declines, and so you're going to earn less money. So a lot of the luxury that people had of earning that 5% yield is dissipating quickly. Secondly, we're still in an environment right now where inflation is 3% plus. And that ultimately means if you're earning 3% nominal on your cash and having a 3% inflation rate, your purchasing power is quickly eroding. And so if you're a corporation planning for capital expenditures in the next few years, if you're a person planning for retirement, this is a juncture where you have to take a moment and rationalize not just where your cash is, but how your investment allocations are. What type of volatility do you want, and are you being paid appropriately for the liquidity you're providing? And that is a fundamental question: is are you being paid appropriately for liquidity? That's a juncture that goes beyond what we're finding in liquid markets, but also private and credit-sensitive markets as well.
Well, it's interesting to hear you say that, that 8 to 10% figure of money market funds are probably risk-taking assets. And to just get into the psychology of risk appetite at this moment, it's not just cash that's seeing inflows, it's gold too, knocking on the door of 4,000 at the same time that you have equity sitting at all-time highs. And it's hard to get a clean read on risk sentiment in this market when you think about those asset classes in relationship to each other.
Well, you also have a demand-supply mechanic going on in the gold trade, as well as sentiments. The animal spirits and the fear of inflation is sort of driving that. Central bank policies and other government policies are driving that as well. But when you put it together, people aren't certain as much as the opportunity cost to be in those risk-seeking environments. Volatility could exhibit itself at some point in the future. And what we're finding from clients is that they want a more sure thing. And the way they derive that sure thing is income generation. And having income generation of sure assets, perhaps asset-backed type of structures that have hard assets, is important. And so while gold is important, it's not as a hard asset. It's not income generating. And so finding that balance is a tension that investors are going to be faced with over the intermediate term here. And right now, with the Fed coming into play, with rates coming down and lack of data, this is a great time to sort of be assessing exactly how those portfolios should be constructed, not just for the next few days, but really for the next few years at this point in time.
I am curious, just longer term. I mean, given the government shutdown, given the persistent discussion right now about our fiscal situation in the U.S. and whether it leads us at some point in the future to a cliff, why aren't we seeing maybe a little bit more of an embrace of longer dated treasuries right now? And I don't mean that just because of what's happening in the government, but just overall, there just does not seem to be much appetite for it unless you have a mandate to go out there and buy it.
One of the interesting things is, we've been proponents at Pimco of yield curve steepening over the long period of time. A lot of that has to do with not only rate cuts in the front end, but longer end term premiums come from the fiscal outlook. But when you look at the shape of the curve, the back end really hasn't moved at all over the past 6 months. Yeah. It's been fairly well studied and received, despite steady increase in issuance. Now, that might change longer term, but you don't foresee rates in the long end going up to 5% and beyond. We find it fairly sticky at this point in time. The demand mechanic remains healthy. So from that perspective, we're going to find ourselves with a balance where term premiums do increase, but that doesn't necessarily mean that yields get out of hand in the longer end.
All right, Jerome, always great stuff. Jerome Schneider, Managing Director and Head of Short-Term Portfolio Management and Funding over at Pimco here on a Tuesday afternoon, where we see yields lower, the VIX higher, a bid into gold, and no bids right now coming into stocks. A full breakdown of all of today's market action is starts right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Katie Greifeld taking you through to that closing bell with a global simulcast. We're joined now by Carol Massar and Tim Stenovec in the radio booth. Welcome to our audiences across all of our Bloomberg platforms, including our partnership with YouTube, on a day where we actually see stocks across the board lower, the major indices, I should say, Carol Massar, and a lot of this seems to be tied to some concerns about the AI trade.
Yeah, well, I mean, it's certainly been such a momentum push in this marketplace overall. I don't know. Is it concerns? Is it just taking a breather? We've seen the S&P 500 up for over a week now. So a little bit of a breather maybe as we get ready for earnings to come, because I hate to say it feels like the markets are kind of blowing off the shutdown for the most part at this point. And we're getting ready to mark a week when it comes to the U.S. government shutdown.
I'm looking at shares of Salesforce right now, dipping just a little bit lower, but kind of where they were before this news came out, down 2.4%, out with a red hat on the Bloomberg terminal. Salesforce telling clients it will not pay hackers for data extortions. The company saying it will not pay a ransom from a hacker who claimed to have stolen a large amount of client data and threatened to publish it. This just crossing on the terminal.
Yeah, and we should point out, I mean, kind of also bearing the lead here. I mean, this is actually the first disclosure, apparently, at least publicly, that I can tell of this breach here. So them saying they're not going to pay it, but of course, the real headline seems to be that there was a breach to begin with.
Yeah, I should point out, too, this is according to an email seen by Bloomberg News, so still waiting for official comment from the company there.
All right, we'll keep an eye on that. The shares had been lower for a good portion of the session anyway, but taking a slight uptick lower as we get the closing bells in New York. Right across the screen for all of the major indices here in the U.S., the Dow Jones Industrial Average, that's actually your outperformer on the day, and it's still down more than 90 points or 0.2%. The S&P 500 dropping about 26 points or 0.4%. The NASDAQ Composite down 0.7. The NASDAQ 100 down 0.6. Also, I just want to point out that the Philadelphia Semiconductor Index, which of course a lot of people are laser focused in on now, down 2% on the day, and the Russell 2000, Carol Massar, losing about 28 points or 1.1%.
Let's not forget, though, the SOX is up more than 30% year to date, so we've seen certainly momentum there, even though we're seeing a little bit of a pullback today. Hey, if you look at the S&P 500, Katie, you've got more than 200 names to the upside, 299 to the downside.
And let's take a look at the sector level as well. Slightly more red than green when you consult the circle there. You can see that tech is actually lower on the day. Feels like we haven't seen that for a while. That sector down by about 0.5%. We know a lot of that comes back to Oracle. In terms of what did well, consumer staples was your big winner when it comes to a percent basis, up by about 0.9%. Financials too as well, but consumer staples being the big winner really speaks to the defensive mood in the market overall today.
All right, having said that, man, there's some real standouts when it comes to gainers in the Tuesday trade.
Yeah,
Trilogy.
let's see what they are.
Trilogy, I'm sure you'll have more to add. Trilogy Metals up 211%. It was up as much as 281% earlier in the session, but finishing with a 211% gain. Ticker is TMQ. It's a $6.50 a share stock. You know the story. The United States taking a 10% stake in the Canadian Minerals Explorer as part of a $35.6 million investment to secure critical energy and mining projects in Alaska. We have seen this trade coming out of the White House. So there's a beneficiary in a big way. AppLovin down 14% yesterday. It was a story that came on our radar late yesterday. Down 14% in the Monday trade, but up 7.6% in today's session. It was a top gainer in the S&P 500, NASDAQ 100. Citi coming out and saying that they would be buyers on any weakness. They say that they noted that the regulator, SEC, has not officially accused AppLovin of any wrongdoing. So they're kind of a little bit, it sounds like, suspect. Keep in mind, the big story yesterday, Bloomberg News breaking that the SEC has been probing the company specifically looking at their data collection practices. That was according to people familiar. But nonetheless, investors moving back into AppLovin. And got to mention AMD. It, again, was among your biggest gainers in the major indices, up another almost 4% in today's session. This kind of another gain for a second day, up almost 24% yesterday, so continuing to build. And that, of course, is the news that AMD has a deal with OpenAI to build AI infrastructure. So some momentum continuing on this Tuesday, Tim.
Well, those are some of the gainers. I got some of the decliners for you. I want to start with Oracle shares today falling by 2.5%. This after a report in The Information said the company's profit margin in cloud computing is lower than many on Wall Street have been estimating. The company's gross margin was 67.3%, the lowest in more than a year due to heavy spending on chips and data center capacity. Oracle shares earlier in the session fell as much as 7.1%, but paired those declines to close down 2.5%. The company declined to comment. Ford shares falling the most today since February, down 6.1%. The Wall Street Journal reported that a fire at a New York State aluminum plant will cause months of disruption for Ford. It's the biggest customer of this plant based in Oswego, though Toyota and Stellantis also use this plant's aluminum. Citi says it's too soon to cut fourth quarter North American light vehicle forecast, but the fire could present a supply risk for the period. Our Bloomberg intelligence team, including Steve Mann, who's going to join our program in just about 20 minutes, says that the drop in the stock also reflects persistent concern over rising warranty costs and its EV business at the expiration of an EV tax credit, crimping demand. And finally, watching shares of sports betting platforms DraftKings and Flutter Entertainment. Flutter is the parent company of FanDuel. Flutter down 3.7%, DraftKings down 5.8%. These took a hit today after Intercontinental Exchange, the owner of the New York Stock Exchange, announced plans to invest as much as $2 billion in the crypto-based betting platform Polymarket. You can kind of bet on anything on Polymarket, guys, not just about elections, not just about how many tweets Elon Musk will send. That was a real one that I saw this morning, but also, of course, on sports as well. So that could be a challenge to these companies
and
that
whether
are pure play
Tim
sports
might have
betting.
a sandwich during our show.
Oh.
That one's an easy one to sort of like.
Is that a very liquid market?
The odds are not maybe so liquid, but the odds are 99.9% that he will.
Okay, I have no idea what they're talking about. Tim ate a sandwich? Is that
Tim,
the
no,
news?
you can bet on whether or not Tim is going to.
Yeah. All right, well, you can also bet on where treasuries are going. You take a look at yields on the screen. They are down across the board here. I should point out that we had seen yields ticking higher for the last few days, really the last couple of weeks here. So a bit of a pullback today as some people pile back in on a price basis.
All right, folks, let's get to some of the stories. By the way, that was a nice segue off, Tim. We were just both nodding how well you did that.
Romaine's a true professional.
You really are.
I am.
If only we could be as good. I'm just saying.
One day.
It's a pleasure sitting next to him.
You know, I'm hoping one day. Hey, listen, you know, inflation, we talk about it a lot still. We know
I've heard
the Fed,
about it.
The Fed is still keeping it, certainly has some concerns. We heard former Treasury Secretary Robert Rubin talk about it. He has some concerns about inflation. Right? It was an interesting conversation. Well, it turns out Ken Griffin and Citadel, they too are concerned about higher prices. Yeah.
Former Chicagoan.
Yeah, exactly. Well, Griffin wishes that his Miami tower cost $1 billion as the price surges. I mean, it's going to cost him, right, Tim, a lot more.
Yeah, $2.5 billion. Construction's likely to begin mid to late next year. He said, I wish it were $1 billion. He was asked on stage about the building at the Citadel Securities Conference in New York on Monday. He said, due to inflation, the cost of construction, it's going to be about a $2.5 billion project. The waterfront project had been expected to break ground in the third quarter of 2025, a spokesperson there said at the time.
See, so nobody's immune from inflation.
Seems like a nice tower.
No one is immune from inflation, but, you know, maybe what he needs to do is actually, you know, get his all the CFAs that he has on staff and get them to crunch the numbers and figure out how to make it work. The only problem is there's probably a smaller pool to choose from here. The latest results from the first level of the three-level CFA exam are in. The pass rate, 43%. That was for the level 1 test takers in August. And of course, historically, this number has been in the 40% range. I think tops out around 50% historically. And of course, during the heyday when I took it and it was still difficult, it was like in the 30s.
I think you had AI do it.
No, AI didn't exist back then.
You did it for real?
It's all human power, man.
Hey, how many
like,
times did you have to take it?
It was like John, what was it, John Henry and was it Paul Bunyan? What was it? I don't know.
I don't know.
Did you pass on your first go-round?
Well, it depends. Which exam are you talking about?
I don't know.
1, 2, or 3.
There's three levels, Carol Master, and no, for the record, it did take me multiple chances to get to the finish line.
But that's
called persistence, Carol Master.
Yeah,
persistence.
He's got grit. Wait, which is the
Don't
hardest
give up.
level?
If you're out there
Three
and
is
you're
the hardest.
struggling, no, actually.
I
can only be like.
I don't know. I don't know if this is violated, but honestly, I felt level 2 was the hardest.
I've heard that, right? That the first one is, a little bit easy. If you make it to the third one, then
Easy, 43%.
everything's relative.
Yeah.
You know what's hard? Giving birth.
Oh my.
Wow. Okay.
All right.
That really puts it into perspective,
I mean, I would argue with you, but I can't.
I know, exactly.
Finally, something. You found something, Carol. He cannot weigh in.
Is this going to be her ace up their sleeve every argument we have now?
Totally.
Hey, you guys got to say goodbye to Carol. This is her last simulcast of the week, okay?
Yeah, thanks.
We're heading out to
always
LA
reminds me I
tomorrow
was
for
born at,
Bloomberg Screen Time.
12:15 in the morning.
Yeah.
So, sorry.
All right, well, have fun in
LA. Good luck.
Okay.
You going to the beach again?
We will miss you.
We will go to the beach, don't worry. BloombergLive.com/screentime. You can still get tickets, maybe.
Yeah, Jimmy
Tickets.
Kimmel.
Maybe.
They're
I know you
charging
can.
for this
David
thing?
Ellison.
Might be sold out. You can definitely watch what we're doing there.
Wow.
All right, we are so silly. It's a Tuesday, that's for sure. All right, guys, that is a wrap. Take care.
It's a Tuesday? What does that even mean?
3 days till Friday.
That is our cross-platform. Folks, of course, Katie and Romain continuing there on the close. We will continue on Bloomberg Business Week Daily, and I'll see you in a week, and you'll be back on Friday.
I'll be here, don't worry.
Those guys will be there, too. All right.
Don't worry, the close carries on. As always, when we come back, a closer look at the markets, a closer look at the S&P, a closer look at the NASDAQ, all with Callie Cox, Chief Market Strategist at Ritholtz Wealth Management. This is The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Katie Greifeld.
And I'm Romain Bostic. After several days of gains, a bit of a reality check for the market. A report out by The Information questioning the profitability of Oracle's AI data center cloud rental business, if you will. That took a leg out of chip stocks with the Philadelphia Semiconductor Index down 2%. It took a leg out of software application stocks, which as a group were down more than 1%. And it took a leg out of all of the major indices today, including the S&P, down about 0.4%, a tick up in the VIX as some of those jitters, not only about the AI trade, but of course also about the government shutdown in day 7. And then take a look at what's been going on in the gaming space. We're going to talk a little about that a little bit later today, Katie Greifeld, but we saw a big leg down for that group as a whole.
Yeah, big time. Take a look at DraftKings, one of the names within that index, down about 5.8%. We got the news that ICE is going to invest $2 billion in Polymarket. We'll bring you the details, but I also wanted to highlight AppLovin, of course. We got the news yesterday, about 24 hours ago. The SEC was looking into their data collection practices. Citi coming out and saying that they would be a buy on any weakness. Shares up 7.6%. And then Ford, there was a fire at their aluminum plant, just one of them. Shares down by the most since April, I believe. But I want to turn to today's top story, and that is the AI spending splurge. I don't know why I gave myself a tongue twister. But in any case, AMD shares rallying once again today after yesterday's deal announcement with OpenAI. Now that news, it landed just weeks after NVIDIA agreed to invest as much as $100 billion in OpenAI to support new data centers. And remember that back in August, OpenAI also agreed to rent about 4.5 gigawatts of data center power. Now, while this has helped fuel the rally, the circular nature of these deals, Romain, has raised some concerns about whether or not the AI ecosystem demand for it, whether or not that's being overstated.
Absolutely. Callie Cox joins us right now, Chief Market Strategist at Ritholtz Wealth Management. And Callie, I do want to start there, particularly given that you and the folks over there at Ritholtz seem to have a little bit more of a focus on value, true value, if you will. And I know there's been a lot of people that have looked at the AI trade, questioned some of these multiples. But the promise was always there, that we saw the top line growth, and the idea at some point we were going to see the profitability catch up to that growth. I know what we learned today about Oracle is just one tiny example in a large pool of AI investments, but I do wonder if it gives you any sort of concern about how far this trade has gone.
It definitely does, and I think this is a part of any technology story where there's a little bit of doubt and skepticism that creeps in. I mean, let's be honest. If you look at every world-changing technology going back over decades, there's been this moment of hope, looking at the potential of what the tech could do, and then the stretch where you're waiting for that tech to actually flow through to profits and economic benefits. And we're stuck in that stretch right now. AI looks promising, but we may have to wait a while to see it become a more profitable, productivity driving strategy for America's businesses.
One thing that I'm curious about too is, there's always been this talk about how markets and really rallies to a large extent run on narratives. And Robert Shiller, I thought, had a great book out a couple years ago exactly on this topic. And the narrative for AI and the broader tech trade has been so powerful. It's easy to buy into it because it makes sense. And I do wonder that if you don't have that narrative, or if there are enough cracks in that narrative, is there still going to be enough to power this market higher as a whole?
Yeah, it's a good question. And going back to your multiples question, I think it's hard to judge where multiples should be. I'd say that in any market environment, especially right now when we have technological change really driving market moves on a day-to-day basis. Looking at valuations, obviously they're a little more expensive in the tech space versus other sectors. That might be a reason alone to rotate out of tech. But overall, narratives do drive markets. If you're investing on a narrative, though, you have to give it years to pay off. And right now, I think it's important to realize the moment we're in for AI and how long it could take for this AI trade to pay off. I think that's still a shock to investors, especially those who don't have years to wait.
Well, Callie, one of the tangles of the narrative that it seems like investors have fallen in love with is, of course, the infrastructure play here, the data center build out. You've seen that certainly light a fire under utilities as a sector. I thought there was some really interesting commentary coming from Kip DeVere over at Ares saying that there is a risk of overbuilding here. When you take a look over the past 20 to 30 years, typically when this much capacity comes online, some of it at the end of the day has to be marginal. And I wonder, how you're approaching that sort of warning over at Ritholtz.
Yeah, well, he's absolutely right. This happened in the late 1990s, too. There was overbuild out and overcapacity, and that capacity simply wasn't filled. It doesn't mean that the internet was a bad idea. Obviously, the internet changed our lives, and we saw that eventually flow into profits. But it might be a little early right now for AI investments, even on the infrastructure side. I would put infrastructure in a different bucket here. I think there are a bunch of different ways to invest in the AI trade, through software, through hardware, through infrastructure, like you mentioned. The infrastructure trade still looks a little bit early, but I think overall you have to be very picky when you're looking at the companies and names that you want to invest in when getting exposure to AI.
Certainly need to be selective there. Let's talk about some other narratives, though, because there is a world outside of AI, outside of big tech. It seems like it's a little bit harder to get enthused about some of those narratives, but when you take a look at the sector level, where else bears attention?
Is there a world outside of AI? That's news to me.
You tell me.
I'm kidding. I'm kidding. I take a macro view, so of course I think there's a world outside of AI. Well, I would take a step back and understand where we are in this economic moment at a point where we're not getting a lot of signals because of the government shutdown. Economic growth, seems to be in an okay place at the moment. It's definitely picked up since the second quarter, but the Fed is still stuck in this rock and a hard place where they want to cut rates, they want to help support the job market, but inflation is really tying their hands behind their backs. I think at this moment it is important, of course, as Romain said, to look for value, look for names that trade closer to their earnings. We think a lot about playing defense in this environment, not trying to be a hero, but ultimately focusing on stability and consistency, especially if you believe in the view that the economy looks a little more on shakier ground than it usually does.
All right, don't be a hero. That's a good place to leave it, Callie. Great to get some time with you. That is Callie Cox. She is Chief Market Strategist over at Ritholtz Wealth Management. Now, coming up later this hour, an interview with Tarang, Amin, the CEO of E.L.F. Beauty, as well as Susan Yara, the founder of the skincare brand Naturism. We'll get their outlook on the billion-dollar beauty industry and what's next for both companies as they continue to grow their partnership. This is The Close on Bloomberg.
Look, we're in a bull market. It's been clear. Asset prices are high, credit spreads are low, consumers still okay, the consumer has jobs. Remember, jobs is what usually starts to force people to cut back and change things, and consumers spend less and companies cut back. So far, so good.
And that, of course, was JP Morgan Chase CEO Jamie Dimon underscoring the strength of the bull market. Now, those bulls gaining even more ground today with the parent of the New York Stock Exchange taking a stake in crypto-based betting platform Polymarket. The Intercontinental Exchange announcing it will invest up to $2 billion in Polymarket, the latest in a string of deals bolstering betting platforms, including CME's partnership with FanDuel and NASDAQ's stake in Gemini. Let's discuss with Bloomberg's Katherine Doherty, who wrote this story. And Katherine, I mean, my first question reading this news was, why invest $2 billion in Polymarket versus building something in-house?
That's a great question, Katie. I think that the first thing that they're going to get by just simply giving this all-cash deal is access to clients that they otherwise wouldn't have maybe attracted right out of the gate. When you think of Polymarket, you're thinking of a huge retail customer base. And when you think of ICE, the New York Stock Exchange, a lot of their clients are the big institutional players that are in traditional finance. And so you have both of these customer bases really merging for the first time, and two companies that have very distinct clients that can really simply just step over and access a whole new market for themselves. And the other thing that this gives ICE is access to data. Data is incredibly lucrative for exchange operators like ICE, and anytime that they're able to provide more numbers and charge their customers for the data that they're streaming, that is going to be a revenue gain for them.
What is ICE's role specifically? So if I make a bet through Polymarket, is ICE involved in some way or another?
So ICE will now have a partnership that gives them access to the data. They can actually stream, presumably, moving forward, what these bets are. And just like you can track how the stock market is and with New York Stock Exchange, Polymarket's data, they'll have a shared data service together. And then the other thing that they're going to be working on, and this remains, there's a lot of questions that come with regulation and how the actual technology does evolve, but tokenization was another part of this announcement that the companies were saying, we're going to work on tokenization together. When you have a traditional firm like ICE and you have this crypto native firm that is used to building, it's used to innovating, those two things, I believe that ICE is making a bet on the tokenization, and that's where the market is headed. They want a player that's going to help them innovate where they might not know where to even start.
All right, Katherine Doherty with one of the most read stories here on the terminal, a closer look at that deal between Polymarket and ICE. Meanwhile, another story we're keeping our eye on is Tesla. The company had teased a big product announcement. We got it. The shares fell. Basically a revamp of some of their models to basically, lower the price just a bit. Max Chafkin joins us right now. He's the host of Musk Inc., and he joins us right now. So let's just cut to the chase here. You're basically taking the Model Y, the Model 3, basically cutting the price.
Yeah, making it a little bit cheaper. I'd say this was a small announcement, kind of posing as a big announcement. I believe it's
sort of like the LeBron announcent, where everybody thought he was going to retire, and apparently selling Michelob or something.
To the LeBron announcement. Cloth seats instead of leather seats. Most of the Model 3s and Ys have glass roofs. That's kind of one of the distinctive features. This new, cheaper version does not. It's really all about making the car a little bit cheaper.
Which is always awkward, those glass roofs, like when there's a big bus going by and you look up and everyone's staring down at you.
I'm not a fan, but I guess people like them. It does create kind of a luxury feeling, I guess, and this is going to definitely be something else, right? This is a lower end model. It's going to be priced that way. I think what's difficult, one of the reasons the price is going down is Tesla investors, they have very high expectations. You're talking about a retail community that really believes in Elon Musk. They wanted more.
And let's just be clear, Katie, when everyone saw that those cryptic X posts or whatever you call them, I mean, everyone assumed this was going to be a new big model of some kind, a new Roadster or something even bigger than that.
I mean, I'd say that people who are following the company closely, including readers of our journalism, knew very well what it was. But among the kind of retail community, the Reddit community, you're absolutely right. Roadster, there were even speculation, he was going to have a GPU. Tesla's going to compete with NVIDIA, or maybe it's going to fly. There were all of these kind of wild thoughts going around on the internet. And again,
and in the newsroom too, Max. Don't cut us out. We're conspiracy theorists too.
Just to wrap a bow on this, it sounds like you're saying that Tesla, in some ways, it's a victim of its own hype cycle, that this was too hyped.
Well, I mean, look, Tesla is wildly overvalued as a car company. And so anytime Elon Musk does anything that makes it look like a car company, it's sort of bound to hurt the stock price. Because if you compare it to Toyota or GM or any other sort of normal car company, it looks very, very expensive. If you compare it, if you think of it as a futuristic AI company that makes flying GPUs, well, then maybe you can justify, the high premiums that it's trading at right now.
Yeah, all right. Well, Tesla shares, you can see that disappointment right now getting a little bit less expensive. Max, great to get some time with you. That is Bloomberg's Max Chafkin. It still is interesting to see this reaction, Romain, because we know there's been demand for a more affordable version, maybe just not this quite package.
Yeah, and I think it's just, like I said, basically you're making really minor changes here. And this obviously seems tied to the loss of that tax credit. I think people want to see something actually new, something brand new coming out of the minds of the engineers, or maybe Elon Musk himself.
Yeah, well, coming up next, top CEOs across the U.S. weighing in on the biggest risks to business. Tim Walsh, the CEO of the new KPMG, joins us to discuss. This is The Close.
KPMG is out with its CEO Outlook today. It's a survey of 400 executives from the largest companies across the U.S. Supply chain resilience, that's emerging as the top near-term risk, with the majority expecting tariffs to impact business significantly over the next 3 years, despite staying confident in their growth prospects over that same time frame. Pleased to say that the new CEO and chair of KPMG U.S. joins us right now, Tim Walsh, here in Studio 2. Great to see you, Tim.
Great. Thanks for having me, Romain.
I could understand in February, March, certainly April, that tariffs would be on the tip of everyone's tongue that you spoke to. Here in early October, are they still talking about it?
CEOs are absolutely still concerned and talking about the impact of tariffs on their business, along with a couple of the other top risks that we're seeing in the Outlook survey, Romain, including AI investment around it and the return on investment that certainly shareholders and boards are looking to understand, and also the risks around cyber. But if I dig into the tariff risk, CEOs, these are major issues that CEOs and companies are dealing with in terms of being able to flex their supply chain, look and analyze where those suppliers can move to, if they can be moved at all, renegotiate supply contracts, look at cost takeout, and then lastly, move toward pricing to the extent their consumers can absorb it, and that is certainly uncertain at the moment.
On the issue of actually where you source from and the idea of maybe potentially moving that around, I mean, it's kind of become a little bit of a whack-a-mole, right? Because you can say, okay, we're going to move out of China, and then you go to India, and the U.S. imposes tariffs there. How are they approaching, I guess, the geographical fluidity, if you will, of trade policy, and how you can maybe set up shop somewhere else and then all of a sudden find yourself still up against the gun?
Yeah, so that's one of the major challenges that CEOs are facing into, not only tariffs, but the changing dynamic around tariffs that are changing sometimes monthly. One of the benefits that we're seeing with AI right now is the fact that it is helping CEOs manage through this risk. One of the major things that we're doing with clients right now is helping them analyze tariffs, helping them understand with big pieces of data very, very quickly, understand what the financial impact is, immediately be able to forecast it into their models and or solve for what-if scenarios depending on what their view is on potential changes to their tariff environment.
So AI emerging as a real tool here for the C-suite, but to Romain's point, the whack-a-mole nature of some of our tariff policy coming from the U.S., for how many CEOs is the answer to just try to move production onshore, domestic production? Is that a possibility?
I think it's very, very difficult for CEOs to move their supply chain, but it is dependent upon the industry that the CEOs are working within. If you look at the automotive industry, for example, it is challenging because you've got such a deep and wide supply chain that CEOs are working through. And so moving that supply chain quickly is not necessarily a possibility. So again, moving very, very quickly to cost takeout and looking at pricing adjustments.
I do think it's interesting that, again, that the top challenge for CEOs in the short term is supply chain resilience, because I feel like that could have been the answer at any point in the last 5 years when you think about the pandemic and where we were, of course, in 2020. And I do wonder if all those different experiences that we've had. Of course, when we're talking about global trade policy and tariffs, that's a different conversation than just what we're talking about with the pandemic. But I do wonder if that has made supply chains on the whole more flexible than they might have been.
I think we're seeing that. And certainly when we get through this period of changing tariffs and that environment around trade policy, supply chains will be much more flexible. But again, is AI helping CEOs around this issue? But in addition, as we're seeing in the survey results, AI is a major topic, certainly for management teams and in the boardroom. As companies, even 1 year ago, if you were to think about it, CEOs were thinking about investing in AI. It was an if, and now it's really truly a when.
Well, when we talk about the when, and I assume we're talking about more about investing in AI for their own corporate purposes, right, and internally improving their workforce or improving their workforce productivity. Is there a sense that they feel like there is enough, the cost benefit is sort of in favor of the benefit in investing in that space now?
So it is a few elements there, Romaine. So it is certainly looking at their own productivity and the way they do business. But CEOs right now are also seeing the advantage of agents, and agents are a complete game changer. Agents will help companies and CEOs design their products differently. They will change the products that are potentially put into market. In some cases, for some industries, they'll have new products to actually to sell. So CEOs are now seeing the efficiency play come through their investments in AI, but it's the rest of that investment and impact and the ability to stay ahead of their competition and of course the capital intensity around that investment that's important to justify.
Another big component of the report was in cybersecurity, and this in a lot of ways directly feeds out of what's going on with AI, because as a lot of companies sort of adopt these AI programs, these AI models, there's a big question of what data you're using. If it's your own proprietary data, how do you protect that? Just today, before you came on the air, there was a headline about Salesforce disclosing a breach of one of its main products that we didn't know about. And we've seen a lot more of this. And I do wonder about the vulnerabilities as these companies do open up, particularly the companies that aren't traditionally thought of as tech companies, sort of move into this tech space and maybe aren't fully aware of the potential vulnerabilities.
So cyber has always been at the very top of the CEO agenda, but it is amplified by the fact that AI is enabling threat actors to harm businesses in a more extensive manner. I think the good news around this is that you can fight AI threat with AI. And so you're seeing AI-enhanced fraud detection, for example, but it is absolutely something that CEOs are very, very much focused on in terms of being able to protect their environment. And what's really interesting is where CEOs were really focused also on inside threat actors. Inside threat actors now are agents. And so you can build an agent, leave it in an environment, and leave a company incredibly exposed. So risks are, again, increasing. And the final risk around cyber that I would just highlight, which is interesting, is the capability around quantum. And so that is showing up now as well in terms of the acceleration on when that capability will be available and in market. Because with quantum, that supercomputing power, all standard encryption can be broken, and companies need to right now start thinking about what that looks like, what their tech environment looks like, and how they will re-encrypt everything from your personal to your company to your government data.
Well, I was hoping you could expand a little bit more on quantum, because this is a conversation we're having on the close as to what is the timeline for really needing to get serious and understanding what exactly quantum computing is. Because even from the mouth of Jensen Huang, the NVIDIA CEO, it feels like that timeline shifts around a lot.
It does shift around a lot, but the concern I have certainly is that that timeline is accelerating. And so if you were to even go a year ago or 2 years ago, you were talking about quantum, what seemed to be in the distant future to some extent. That timeline is accelerating. I have not heard a definitive when. And so what I can tell you is that our clients and CEOs are beginning to do those assessments. And our advice certainly is to start looking at those quantum assessments right now, because it is a journey to be able to get through that, not only the assessment, but the changes that are required.
Well, certainly investing in quantum stocks has paid off handsomely this year, but I digress. Let's talk a little bit about M&A, because I thought this was an interesting finding in the Outlook as well, that 33% of U.S. CEOs indicate that they have a high M&A appetite. So they're motivated buyers here in this specific environment.
Yeah, that is good news, certainly. It's interesting because the uncertainty and the challenges that we've been talking about already here have really taken the attention of CEOs and businesses elsewhere. But it's becoming this this conclusion that this uncertain environment is one that we just need to work within. And so companies are getting back onto their original strategy, and we're starting to see M&A certainly around first some larger deals.
Yeah. Well, that's what I'm curious in terms of just overall the risk appetite that you're hearing from these CEOs and other folks in the C-suite. Is it there, or is it just kind of we're still waiting to figure out where all this goes before we really do anything aggressive?
So CEOs are confident, and you can see that come through the survey results. They're confident that, there are many challenges, but that they can manage through them. And you're seeing that confidence, I believe, start to pick up in the M&A markets right now. And so we shall see. We shall see where it leads to. Listen, certainty will lead to more consistency in the markets, and I believe more deal activity, and time will tell.
All right, Tim, great to get some time with you. Really appreciate you stopping by the studio. That is KPMG U.S. CEO and Chair Tim Walsh. A really interesting conversation, Romaine, and quantum computing, tokenization, all on my lists of things to actually maybe read about on the weekends.
I thought you would have read up on that already.
I mean, I'm there. I understand. I know what it is, but I feel like I don't understand it.
Well, I thought his comment about quantum computing was a big one. I mean, we've spoken with a few of the CEOs of some of these quantum computing companies. Obviously, they're still a ways away from this becoming sort of a viable business, but we talk about sort of what it can do, and more importantly, what it can do in the wrong hands.
Absolutely. And if you're in the C-suite and you're trying to future-proof your business, certainly something that you need to read up on right now, probably. Let's take a look at how markets closed on the day. The S&P 500 snapping that winning streak, as we've been discussing, finishing about 0.4% lower. A little bit of a bid into the bond market. Yields down about 3 basis points on your 10-year yield. That run into gold, though, has been really breathtaking, I would say. Yeah, 39.82, a flirt with 4,000. Other precious metals getting a bid as well. And take a look at the VIX, Katie. Yeah, gold rising, the VIX rising. Certainly a risk-off day. This is the close. Well, the beauty sector booming, with data showing that the industry is worth $450 billion. Now, one brand looking to capitalize on that is Naturism. They just launched their first ever brand activation in LA. And joining us to discuss further, I'm pleased to say, is Susan Yara. She is the founder of Naturism, as well as Tarang Amin. He is the CEO of E.L.F. Beauty, which is the parent company. Great to have you both with us. And Susan, I'll start with you because this is your first brand campaign, global brand campaign, as we mentioned, since you were acquired by E.L.F. back in 2023. So why now? Why in 2025 are you launching this?
Well, thank you first off for having me on the show today. This is really important to us. When we were first acquired by E.L.F., we were only at 5% penetration, which means that there is a lot of room for us to really get out there and get our name out to consumers. But it really took a second for us to focus on distribution, work with the E.L.F. team, and really get our bearings. And so we've started to really expand globally and make that a focus. So now it's time for us to really get the marketing out there.
Well, Tarang, let's talk about that a little bit more, because E.L.F. has been pretty acquisitive over the past couple years. And when it comes to especially the distribution piece, what can E.L.F. bring that maybe some of these brands that you bring on couldn't have necessarily done on their own?
Well, first of all, we have a very high bar when it comes to M&A, just given the strong organic growth of our existing brand portfolio. Every one of our brands grew this last year. And so when we look to M&A, we really look to our vision of building a different kind of beauty company, one that builds brands, that disrupts norms, shapes culture, and connects communities. And we very much found that with Naturium. And our approach is different. Our approach is not to overly integrate any of the acquisitions we do, but to actually support a founder's vision. Susan Yara has an incredible vision for Naturium. And so some of the things that we can do to help her accelerate that vision is we were able to expand the brand into all Ulta Beauty, into Boots, additional customers, invest more behind the marketing, and enhance the team. And so those are the areas that we've stayed focused on.
I am curious, Tarang, just about general trends right now. We've talked a lot on this program about the idea that Gen Z, which has been, I think, a big driver of E.L.F's growth, that they may be pulling back just a little bit from some of their beauty purchases, not necessarily in terms of volume, but certainly on a price basis. And I'm curious as to how, if you're seeing that on your end.
Well, I think we're different that way. We're by far the #1 brand amongst Gen Z. I think we're a 35% mind share. The second highest brand is 9%. And so we have real strength in Gen Z, Gen Alpha, and millennials. And so we continue. I mean, I think this last quarter, we announced our 26th consecutive quarter of net sales growth. We're also the only brand to grow market share for 26 consecutive quarters. So we continue to be strong, and mainly because we have the brands that Gen Z, millennials, and Gen Alpha want, and we know how to engage them.
Well, Susan, I do want to talk to you just about kind of your evolution and, founding this company, 5, 6 years ago, whenever it was. And the idea that you sort of tapped into a certain zeitgeist at the time, particularly with some of the younger buyers, but also with people, even, of my generation who are looking for, I guess, cleaner beauty products. And at the same time, we don't necessarily want to pay, $300, for a La Mer, lotion or something.
Exactly. Well, I'll throw out there just to add to what Tarang was saying. The industry doesn't need more beauty brands. They need really great beauty brands, not generic ones. And so I think that's where we stand out a lot and why we loved joining E.L.F. Beauty as well. For me, I had been online for a very long time. I'm one of the adults online, is what I like to joke and say. I've been online since before YouTube was owned by Google. So I really have had the opportunity to see what my viewer was purchasing, what kind of products they really were gravitating towards, the ingredients, the price points, the retailers. So that was something that we really took into account in forming Naturium and creating these products. But for us, it really comes down to consistency. We want our consumer to be consistent with their skincare routine because that's when they see true results with their skin. So we wanted to make sure that we created biocompatible products, meaning that your skin actually recognizes the formulations, the pH levels are really great for your skin. They're clinically effective, and they're at price points that make a lot of sense. And so I think that really has stood out to our consumer.
I hear what you're saying. I consider myself chronically online as well. And I do want to talk a little bit about how you reach new customers, because there is the TikTok of it all. You, of course, just held your first in-person pop-up event. And from what you've seen so far, I mean, what is the ROI reaching someone on the internet, on their phone, versus being able to actually get a sample, get product into their hands physically?
Well, we know that our products are phenomenal. They're really great. They're great price points. And once we get them into the hands of a consumer, they're going to come back and repurchase. So our repurchase rate is about 50%, which is much better than our competitors that tend to be about at 30% repurchase rate. So we just want to make sure that people are trying our products and see just how great they are. That's why this pop-up is really important. Yes, it's good to have campaigns on social media and to talk about education, let people know why our products are different, because there really is so much to say about our products because we formulate them very thoughtfully. But it's when a person tries the product that we are in. They become part of our community and they trust us and they come back and purchase more and more of our products.
And Tarang, I'm curious, from where you're sitting, what you're seeing in terms of consumer demand when it comes to skincare, which of course we're talking about with Naturium, versus beauty products. I think when most people think of E.L.F., they think of makeup naturally. But when you look at your portfolio, do you see any trends emerging there?
I think one thing that we see is a blurring of the lines. You're now having makeup products that have many more skincare benefits. You've got skincare brands, including some hybrid approaches. So what we're seeing is there's a huge appetite, particularly amongst Gen Z, Gen Alpha millennials, for both color cosmetics and skincare. And we've been seeing both markets rise.
So, Tarang, as we sort of move forward in this evolution, I guess the question is, what types of acquisitions, if at all, would you be looking to make going forward?
Well, I'd say it's similar to Naturium or in our most recent acquisition, Rhode, brands that are disrupting the industry. I mean, Naturium went from 0 to $100 million in less than 2 years. Rhode went from 0 to $212 million in less than 3 years. And so these brands that break through and are really resonating with consumers is our first focus. The second is we want them to be able to meet our vision of disrupting norms, shaping culture, and connecting communities. So very strong orientation in terms of delighting our communities, and of course, just real confidence in the quality of the products and how much white space is ahead.
Sarah, and I want to, Susan, excuse me, I want to just give you the last word here, and this is really just about the idea of expansion and sort of where you think you can take Naturium. I mean, at some point, we get this idea that, okay, if you have enough product lines and enough areas here, I mean, what becomes of that? Can you envision this as a company as more than just what you have now, or is it just about deeper penetration with the existing lineup of products?
I mean, we want to be a household name, and we will be. This is something I promised Tarang a couple of years ago when we first started talking. Global expansion is a very big priority for us. Right now, you can find us in the United States in big retailers like Ulta, Target. We're also on Amazon. In Canada, we're in Shoppers Beauty. We're also in Space NK and Boots in the UK. And now we're about to launch in Sephora in Australia. I'm actually headed there next week. And it's just it's a really important portion of our business is to make sure that everyone really gets the opportunity to try our products and use our products, because we really do feel like everyone deserves to look their skin.
All right. Well, this was a real treat, and Susan, and I should just also point out, I actually became aware of you during the pandemic because, you know, when we were in lockdown, I had to learn how to do my own makeup, which, you know, I'd never learned to do. And so I was scrolling through all the beauty influencer videos, and that's how I first came across you. Anyway.
I love it.
Anyway, I've been following your career for a while. The best of success to you, Susan Yara there, the founder of Naturium, and Tarang, thank you for your time as well. Tarang Amin, the CEO of E.L.F. Beauty. When we come back, we'll set you up for what to watch over the next 24 hours. This is Bloomberg. Wrapping up another interesting day on Wall Street, a day that was driven by some concerns about the AI trade. Tomorrow, though, the market will have to parse, well, a few things. Day 8 of the U.S. government shutdown. So far, the market hasn't been too fazed by it, though you did see some continued buying into gold and some other safe havens. Yeah, it'll be interesting to see if we get any movement there from either side of the aisle. So far, certainly just a standoff. But we do get FOMC meeting minutes at 2 p.m. That'll be somewhat interesting, a little stale, but we're not getting economic data, so something to look forward to. Yeah, that'll be a little bit backward looking. We are going to get some forward looking, potentially, I guess, commentary out of a couple of Fed speakers, including Muslim and Barr. We'll see if that moves the needle. But Bloomberg Screen Time actually kicks off tomorrow, which I'm actually excited for. They've got some great speakers this year. Absolutely. Jimmy Kimmel, he has an interesting story to tell. So too does Netflix co-CEO Greg Peters. Looking forward to tuning in. We'll have full coverage of that right here on Bloomberg. Katie and I will be back tomorrow, right here, same time, right here on Bloomberg.